Let me share something with you that might challenge everything you think you know about investing as we head into 2026. Most people believe that successful investing requires predicting the future, timing markets perfectly, or finding some secret strategy that others have missed. They spend their days watching financial news, analyzing charts, and trying to guess what the Federal Reserve will do next. And yet, despite all this effort, the vast majority of investors underperform the market. They work harder, worry more, and end up with less. There is a profound lesson in this, and it has guided every investment decision I have made for over 7 decades. The truth is remarkably simple, almost disappointingly so. The rules that will serve you well in 2026 are the same rules that would have served you well in 1956, in 1986, in 2006, and in every year between. They are timeless because they are rooted in fundamental truths about business, human nature, and mathematics. They do not change with the headlines. They do not shift with political administrations. They remain constant because the underlying principles of value creation and wealth accumulation have not changed in centuries and will not change in the centuries to come. The first rule I want to share with you is perhaps the most counterintuitive, and it is one that most people get dangerously wrong. Cash is not safety. I know that sounds strange. When markets become volatile, when uncertainty rises, the instinct for most people is to sell everything and hold cash. It feels safe, it feels prudent, it feels like you are protecting yourself. But let me explain something most people misunderstand about cash and about what safety really means. When you hold cash, you are not holding something stable. You are holding something that loses value every single day. Inflation, that quiet thief that never makes headlines, erodes the purchasing power of your dollars constantly. At 3% inflation, your money loses half its value in about 24 years. At 4%, it happens in 18 years. This is not speculation. This is mathematics. And yet people feel safe holding an asset that is guaranteed to decline in real terms over time. They fear volatility in stock prices while ignoring the certain erosion of their cash holdings. This is one of the great ironies of investing. Think about it this way. If you had put $100 under your mattress in 1970, today you would still have $100. But that $100 would buy you what $12 would have bought in 1970. You would have lost nearly 90% of your purchasing power while feeling perfectly safe the entire time. Meanwhile, if you had invested that same $100 in a simple index fund, you would have thousands of dollars today, despite all the crashes, recessions, and scary headlines along the way. The person who felt safe lost almost everything. The person who endured volatility built real wealth. This does not mean you should never hold cash. Cash has its place. It provides optionality. It allows you to take advantage of opportunities when they arise. But holding cash should be a strategic decision, not a fear-based one. And you should never confuse the comfort of cash with actual safety. Real safety comes from owning productive assets that grow over time, assets that produce goods and services people need, assets that generate earnings year after year regardless of what happens in financial markets. This brings me to the second rule, which is to focus on owning wonderful businesses rather than trading pieces of paper. When you buy a stock, you are not buying a ticker symbol. You are not buying a chart pattern. You are buying a piece of a real business with real assets, real employees, and real earnings. If you would not be comfortable owning that entire business for the next 10 years, you should not own a single share of it for the next 10 minutes. This shift in perspective from trader to owner changes everything about how you approach investing. When you think like an owner, you stop caring about daily price fluctuations. If you owned a farm, you would not check its market value every day. You would focus on whether it was producing good crops, whether the soil was healthy, whether you had reliable water sources. You would think about the long-term productivity of your asset, not its daily quotation. Stocks should be viewed exactly the same way. The daily price is just noise. What matters is the underlying business and its ability to generate earnings over time. What makes a wonderful business? There are several characteristics I look for. First, the business should have a durable competitive advantage, what Charlie and I call a moat. This might come from a powerful brand that customers trust and prefer. It might come from network effects that make the product more valuable as more people use it. It might come from cost advantages that allow the company to undercut competitors while still earning healthy profits. It might come from high switching costs that make customers reluctant to change providers. The source of the moat matters less than its durability. You want advantages that will still be there in 10 or 20 years, not advantages that can be competed away quickly. Second, wonderful businesses are run by honest and capable managers who think like owners rather than employees. They allocate capital wisely. They communicate truthfully with shareholders. They have skin in the game and their interests are aligned with yours. This is harder to evaluate than financial metrics, but it is equally important. The best business in the world can be destroyed by poor management, while a good business with excellent management can become great over time. Third, wonderful businesses generate strong returns on capital without requiring excessive debt. They produce more cash than they consume. They have pricing power that allows them to raise prices without losing customers. They operate in industries with favorable long-term dynamics. These businesses are not always the most exciting or the most talked about. Often they are quite boring, but boring is good in investing. Boring means predictable. Boring means reliable. Boring means you can sleep well at night. The third rule for 2026 is to ignore macroeconomic predictions. I know this sounds strange given how much attention is paid to economic forecasts, interest rate predictions, and market outlooks. Every day there are experts on television explaining what they think will happen next. And here's what I have observed over 50 years of watching these predictions. They are wrong far more often than they are right. And even when they are right, the timing is usually off by enough to make the prediction useless. Let me explain something most people misunderstand about economic forecasting. The economy is an incredibly complex system with millions of variables, feedback loops, and human decisions that cannot be modeled accurately. Anyone who claims to know what interest rates will be in 12 months, or what GDP growth will be next year, or when the next recession will occur, is either fooling themselves or trying to fool you. I have never made an investment decision based on a macroeconomic forecast, and I never will. Instead of trying to predict the unpredictable, focus on what you can actually know and control. You can analyze a business. You can understand its competitive position. You can evaluate its management. You can estimate its intrinsic value. You can control your own behavior and emotions. These things are within your circle of competence. Macroeconomic predictions are not. The energy you spend worrying about interest rates or election outcomes or international conflicts is energy taken away from the work that actually matters. I remember vividly the fear that gripped markets in 2008 and 2009. Everyone was predicting the end of capitalism. Banks were failing. The economy was collapsing. It felt like the world was ending. And yet, that turned out to be one of the best buying opportunities of my lifetime. The businesses I purchased during that period have generated enormous returns, not because I predicted the recovery, but because I focused on buying wonderful businesses at attractive prices and trusted that the American economy would continue to grow over time, as it always has. The same pattern repeated in 2020. When the pandemic hit, markets collapsed. Fear was everywhere. And once again, it turned out to be an excellent time to buy. Not because I knew how the pandemic would unfold, but because I knew that good businesses would adapt, that human ingenuity would solve the problem eventually, and that prices were far below intrinsic value. Trying to predict the specifics is futile. Having conviction in the long-term trajectory is essential. This leads directly to the fourth rule, which is perhaps the most famous piece of investing advice I have ever given. Be fearful when others are greedy and greedy when others are fearful. This sounds simple enough, but it is extraordinarily difficult to practice. Human psychology works against us. We are social creatures who take comfort in consensus. When everyone around us is buying, it feels safe to buy. When everyone is selling, it feels dangerous to hold on. Our emotions push us to do exactly the opposite of what we should do. Think about this logically for a moment. If you were shopping for groceries and you noticed that prices had dropped significantly, you would be delighted. You would buy more. You would stock up. You would feel like you were getting good value. But when stock prices drop, most people panic. They sell. They feel like something has gone wrong. But why should stocks be any different from groceries? When prices go down, you are getting more for your money. This should be cause for celebration, not fear. The challenge is that stocks come with price quotes attached to them every minute of every day. And those price quotes carry emotional weight. When your account value drops by 10 or 20%, it does not feel like a sale. It feels like a loss. It feels like you made a mistake. It triggers deep psychological pain that evolution has wired into us over millions of years. Overcoming this instinct requires understanding and preparation. You need to know before the decline comes how you will respond. You need to have conviction in what you own so that falling prices become opportunities rather than catastrophes. Over time, this matters far more than people realize. The returns you earn over a lifetime of investing depend enormously on your behavior during the small number of truly frightening periods. Most of the time, markets go up. Most of the time, there is nothing special to do. But during those rare periods of genuine panic, fortunes are made and lost based on whether investors can control their emotions. Those who sell at the bottom lock in losses that can never be recovered. Those who buy at the bottom create wealth that compounds for decades. I have seen this pattern repeat throughout my career. In 1973 and 1974, stocks fell nearly 50%. Those who sold missed one of the greatest bull markets in history. In 1987, the market dropped over 20% in a single day. Those who panicked missed the subsequent recovery. In 2000, technology stocks collapsed. In 2008, the financial system nearly imploded. In 2020, a pandemic caused the fastest bear market ever. In every single case, the best response was the same. Stay calm, assess value, act rationally, do not let fear drive your decisions. The fifth and final rule I want to share with you is the most fundamental of all. Patience is your greatest competitive advantage. In a world obsessed with speed, where information travels instantly and everyone is looking for quick results, patience has become the rarest and most valuable quality an investor can possess. It is also the most accessible. You do not need a high IQ to be patient. You do not need special connections or insider information. You simply need the discipline to wait. Let me explain why patience matters so much. The power of compounding, that mathematical force that turns small sums into large fortunes, requires time to work. In the early years, the results seem almost trivially small. A 10% return on $1,000 gives you $100. That is not life-changing. But leave that money invested for 50 years, and you have over $100,000 from that original investment. No additional contributions, just time and a reasonable rate of return. Most investors never experience this magic because they cannot sit still long enough. They trade too much. They try to time markets. They chase performance. They get bored and look for excitement. And every time they act, they incur costs, transaction fees, taxes on gains, the opportunity cost of being in cash when they should be invested. These costs seem small individually, but they compound just like returns do. Over a lifetime, they can easily cut your final wealth in half or more. The market is designed to transfer money from the active to the patient. This is not a metaphor. This is a literal description of how markets work. Every time someone sells in a panic, someone else is buying. Every time someone chases a hot stock at the top, someone else is selling. The patient investors, the ones who buy good businesses and hold them through thick and thin, are on the receiving end of these transfers. They are not smarter. They are simply more patient. As we look toward 2026 and beyond, I want to leave you with this thought. The world will always seem uncertain. There will always be reasons to worry. There will always be experts telling you that this time is different, that the old rules no longer apply. Do not listen to them. The fundamentals of investing have not changed. Own good businesses. Pay reasonable prices. Ignore short-term noise. Control your emotions. Let time work for you. The rules I have shared with you today are not complicated. They do not require special knowledge or sophisticated analysis. What they require is far harder than intelligence. They require temperament. They require the ability to stay calm when others panic. They require the discipline to hold on when every instinct tells you to sell. They require the patience to wait for years or even decades while your investments compound. I have been investing for over 80 years. I bought my first stock at 11 years old, and I have often said I started too late. Over that time, I have seen countless market cycles, countless crises, countless predictions of doom that never materialized. And the lesson I have learned again and again is that the simple rules work. They work in good times and bad times. They work in recessions and expansions. They work regardless of who is president or what the Federal Reserve is doing. The investor who understands these rules and has the discipline to follow them will do well in 2026. They will do well in 2036 and 2046 as well, because the rules are not about any particular year. They are about timeless principles that have governed wealth creation since the beginning of commerce. Own productive assets. Think like an owner. Ignore the noise. Be patient. These four ideas, properly applied, are worth more than all the sophisticated analysis in the world. Time is the friend of the wonderful business and the enemy of the mediocre one. As you move forward, remember this. The question is not what the market will do next year. The question is not what the economy will do. The question is whether you have the discipline to follow principles that work even when they are uncomfortable, even when everyone around you is doing something different. If you can do that, you will do very well indeed. The opportunity is there for anyone willing to embrace it.